Interest rates just saw the biggest one-week dip in over a year. What happened? Why'd they move lower? And more importantly, what's likely to come next? Join us as we go through all of the data to help you make the best decisions as a home buyer, homeowner, or real estate professional in today's market. Let's jump into the chart so you can see exactly how big this move was. We started the week at about 4.19% on the 10-year Treasury, ended at about 3.78. So bigger than a 0.40% dip in yields on the 10-year Treasury. That doesn't directly translate to mortgages, but let's look here. You're going to see a very similar chart. Not a lot of movement through the first part of the week, and then we get a heavy slate of data starting with the Fed announcement on Wednesday, leading to a pretty much straight line up and 108 basis points of improvement, which is about 0.25% in interest rates. 0.25% better on Friday than where we started the week on Monday. What happened that caused that drop? Tons of data, primarily related around employment this week. On Monday, we had the Treasury announce their quarterly refunding. This is basically where the government comes out and says, here's how much we racked up on our credit card, and we need people to buy Treasury bills, bonds, and notes to finance our spending. Over the better part of 2022 and 2023, they were announcing bigger borrowing needs, which leads to additional supply in the bond market, which has to be absorbed and pushed interest rates higher in addition to inflation. So this week they came out and said, hey, we kind of have our borrowing under control and it's not expanding at the rate that it was in the market like that. On Tuesday, we got the first look at jobs data this week. The job openings and labor turnover survey came out. It was actually a little bit stronger than what was wanted or hoped for, meaning there were more job openings. That is considered inflationary by the Fed because when there's more job openings than people looking for jobs, they feel like employers are going to have to pay more to fill those jobs, which is inflationary. Now, what we saw is the subcomponent in there, the employment cost index, actually dipped. And that was the important part. Market really liked that because when we see that we're not seeing the big wage gains, doesn't lead to additional spending, continues that narrative of inflation coming under control. Wednesday, you all know we had a Fed announcement. The Fed did not cut as expected. They came out, the market interpreted the Fed announcement and more importantly, Powell's Q&A afterwards as fairly dovish or benign. Basically, he didn't commit to anything, but said if we continue to see the improvement in inflation and a little bit of slowing in the employment market, then we are comfortable starting cutting, or it would be appropriate to cut starting in September. So the weekly jobs report came out on Thursday, showed again, more unemployment claims than expected, a little bit of a slowing, not a terrible slowing. We're not in a terrible jobs market, but a little bit of slowing. And then the big news hit today, which led to that big move today in interest rates lower. And that was the non-farms payroll report. Monthly, the Bureau of Labor Statistics comes out and they say, how many jobs were created last month and what is the unemployment rate? So we had a miss on both sides. We were looking for, I think, 178,000 new jobs. The figure came in at 144,000. That's positive. We're not losing jobs. We're just not creating enough jobs for the population growth that we see on a month-to-month basis. On the unemployment side, the unemployment rate ticked up from 4.1 to 4.3%. And that's despite the fact that we are still seeing these big monthly adjustments that the Bureau of Labor Statistics makes, assuming that there are 250 to 300,000 new businesses created every month. And it's just not happening. So we get the QCEW data about 6 months after the fact, and it is showing that the BLS overstated job creation in the fourth quarter of last year by about 300,000 jobs or 100,000 a month. We have no reason to believe that's not the case right now. If we only created 144,000 jobs and it's overstated somewhere in the ballpark of 100,000, we have close to a stall in the employment market, which would tell us we're having the opposite. Rather than wage-based inflation, we're going to have some wage-based pressures downwards on prices as more people are unemployed, wage gains aren't quite as big, which leads to better interest rates. So let's look at this graphically. You can see here 144,000 jobs, under 200,000, still positive, just a clear downtrend in job creation and currently jobs not keeping pace with growth in the population. Unemployment rate, again, sliding upwards here. We had been down at about 3.6%. We're all the way up to 4.3. You're going to hear people talking about the SOM rule, which is, again, one of those economic measures that's sort of a forecast that we are in a recession or a predictor that we are already in a recession that has not been called yet. We're likely to see that trigger soon, although it has not yet triggered. So in looking at the 10-year yield over the course of the week, you can see pretty flat, Fed day, we saw a drop down. We get that econ data that we talked about on Thursday. Again, another leg down. And then most importantly, this big drop here in following the jobs data released today. Always like to show you this chart. Those two green lines are what's called a downtrend. It's a channel. So when interest rates go down, they don't generally go down in a straight line. They'll go down, they'll give a little back, they'll go down, they'll give a little back. And that down channel has been in place since about April. And we've seen a run from 4.8, 4.9 almost on the 10-year, all the way down to today, 3.8. But what is important about this chart is seeing when we are in one of these channels, a big breakout can be an indicator of a couple things, a new trend. But in this case, market may have gotten ahead of itself. We're going to find out over the next couple of weeks. So if you're in the market, talk to your mortgage professional, talk to your real estate professional, and see if maybe this is a good time to consider locking your interest rate. But this is what I wanted to point out. If we go back in the fall of last year, we saw some really nice improvements. Late 2023, interest rates had peaked all the way up at 8%. After that, it looked like inflation was under control. It looked like the Fed was on pace to start cutting in the first half of 2024. And we had run down to this exact position that we're at, 3.8 on the 10-year Treasury. This is going to be an important level of resistance. It tells us that it might not give way on the first push here, although the market is believing it is going to give way. So just pointing out here that we may back up into this channel, and that would tell us we are still in a decreasing rate trend, but we just got a little ahead of ourselves. I believe from everything that we're seeing now, inflation is moderating. We're finally seeing the reduction in shelter costs trickling through to the inflation measures, and we will see those month over month continue to trend down as the unemployment rate ticks up. And the Fed may actually be behind the curve here, and we're going to see what the markets think about that. So here we are with the market Fed funds expectations. This just shows what the market believes Fed funds will look like at the end of the year. Prior to the Fed meeting, they were saying it should be somewhere between 50 basis points to 75 basis points lower than where it is right now. So 2 to 3 cuts between the end of the year. After the Fed spoke, it quickly ran to, hey, 3 cuts are baked in. And then today, after all of this, we're looking at the market is expecting 4 cuts. We only have 3 meetings. So that means one of those cuts has to be at least 50 basis points. So here is the CME FedWatch tool. Market participants actually betting with real money in the markets. This is what's important here. We're at 525 to 550 on the target Fed funds rate right now. There's a 31% chance of a cut. There's a 100% chance of a cut at the next meeting in September, but 31% chance of a 25 basis point cut and almost 70% chance that we see a 50 basis point cut. Then let's look, even if they did the 50 basis point cut, we're seeing a 70% chance of another 25% at the following meeting in November, with a 30% chance of another 50 on top of that. And more importantly, we look here at the end of the year after the last Fed meeting in December, 74% odds that we are 125 basis points below where we are right now. So 5 cuts throughout the rest of the year. Any way you cut it, none of that is priced into the market. I shouldn't say none of that. We have maybe 25 to 50 basis points of those cuts priced into the market. We could see another 50 to 75 basis points before the end of the year. What does that mean in interest rates? I highlighted here the 52-week range. The 30-year, the 15-year, and jumbo rates are all at 52-week lows. FHA and VA loans are slightly above that. Again, we like to go with the Mortgage News Daily rate of all of the online sources that you could go and look at. These are the most believable and accurate. They're not taking online advertisements from liars wanting to post the lowest interest rate to get your click. This is an actual survey of lenders of what is being offered today. So we're down to about 6.4% on the 30-year fixed, which is down at least 0.75%, if not almost a full percent over the last 60 to 90 days. And honestly, we're seeing lenders offering better rates than that. For my best qualified borrowers, we're well below 6.4%. So what do we have coming next? A light data slate next week. On Monday, we have ISM services. If the ISM services were to come out hot and showing inflation in the services component, that could put a little bit of a damper, or maybe we see some give back. If it doesn't show that, it shows service inflation moderating, you could see gas on the flames of this rally and see another further improvement. Wednesday, we get a look at the 10-year note auction. That will always be very telling after we've seen a big move down. How does does the market react to an auction of bonds at a new, much lower yield? And then on Thursday, we get another look at those weekly jobless claims to see how that is going. This is the point where I like to remind you, we do this every Friday. So if you like the content, subscribe, make sure you get notified when we post this every week so you can stay up to speed. And whether you already own a home, whether you're looking to buy your first home, or you're a realtor looking to advise your clients, we go through everything you need to know in about 10 minutes to stay on top of the market. So with that, if you have any questions, if you want a second opinion, if you want a quote, if you want to get pre-approved, my name is Josh Lewis. I'm a certified mortgage consultant with 29 years of experience, and I would love to help you. Have a great day. We'll see you next week.